operating and financial leverage. Our objectives today are to talk about what leverage is, and basically it's the ability to make money, say from a small amount and make a larger amount. So just like you would put a screwdriver into the lid of a paint can and push on the end of it. The longer the screwdriver, the more leverage you have. Same kind of thing, except we're talking about money. We'll also calculate the break-even point, and we'll talk about operating leverage versus financial leverage. One has to do with fixed costs and variable costs. The other one has to do with debt. So we're going to talk about financial leverage, you can see, and then we're going to talk about the combined leverage. Now, it's used to magnify or lever the potential return. You have two types of fixed costs, the fixed operating costs and then the fixed financial costs. So interest is variable, but it varies based on interest rate, the amortization period, and the principal, not your sales. So that's what we're talking about. We're talking about variations based on different activity levels for a business. You can see the two types of leverage as identified on the screen. Now, the operating leverage has, as you can see, is related to capital assets and associated fixed costs with those capital assets. Financial leverage, as I mentioned earlier, has to do with debt and the debt structure. They're both very important to a business, and it determines how a business responds to changes in the economy. You can see from the income statement, the contribution margin, and the operating leverage is related to contribution margin and fixed costs. And the financial is further down the income statement where you start getting into earnings before taxes and earnings after taxes, especially earnings before taxes. Now, break even. This is something you're probably quite familiar with. You have fixed costs. They don't change based on a change in the cost driver. So example is rent. Doesn't matter how long the month is, you still pay the same amount of rent. Same as like, say, a car payment. It doesn't matter if the month is 31 days or 28 days, you still have the same monthly car payment. Variable costs, you have to be careful with it. What causes it to vary? So driving your car will increase the consumption of gas. It'll also increase the amount of depreciation you have. Going on a trip, the longer you stay, typically, the more you're going to have to pay in things like accommodation. So if you take a trip and fly somewhere, the flight will typically be fixed. It doesn't matter if you go for a week or you go for a month, you'll pay the same amount for airfare. The other, the variable cost, well, you'll have to pay more for accommodation. Typically, again, if you stay a month compared to certainly say a week. Then you have some that are semi-variable costs, but at this point, don't really pay attention to those. It's mainly the variable and the fixed costs that are important. And you'll see that semi-variable are utilities, repairs, things along that line. So, degree of operating leverage, percentage change in your operating income divided by the percentage change in the unit volume, or how much your output. And it measures the sensitivity of a firm's operating income to a change in sales. Some businesses are very sensitive to a small change in sales has a large effect on profits. Depends again on things like profit margins. So a small change in the amount of sales can have a huge impact on the company's bottom line. So a highly leveraged company has higher risk, and a lower leveraged company has a lower level of risk. So you can see that, as it says in the very bottom line, it magnifies losses as well as profits, which is risk. Risk has to do with how much variability there is. So if one year you're making $3 billion, the next year you're losing 2, that's a very risky company compared to a company that makes 200 million and then makes 150. It doesn't vary by as much. It's much more stable. So a company like Walmart would be much more stable than, say, a company like Air Canada. Financial leverage. The percentage change in earnings per share divided by the percentage change in earnings before interest and taxes is how you calculate it. And again, sensitivity, the bottom bullet point, the sensitivity of a firm's earnings to a change in operating income. So again, some companies are very sensitive, which means that a small change in earnings, again, will have a large change in operating income. And so you can see the operating profit divided by the earnings before taxes will give you a degree of financial leverage. Combined leverage, take the percentage change in earnings per share and divide it by the percentage change in either sales, if you have dollars, or volume. Usually it'll be sales because it's just based on one product. It'll be multiple products that you sell. So you can also take it and take the degree of operating leverage and multiply by the degree of financial leverage to get your degree of combined leverage. So just multiply the two. And here's the formulas for you that you'll need to solve the problems. Thank you.